Okay. So, yeah, so I'll do a very brief summary of what we did in the last lecture. We had begun the last lecture by critiquing the Ohio school from two different perspectives. One was a sort of a political economy critique of the Ohio school's scholarship, its assumptions, and its prescriptions. And the second was a critique from the vantage point of the new institutional economists, right? So that was how we had begun the last discussion. We then went on to the global political economy and changes in the global political economy that have been conducive to the era of microcredit. That was the second theme, in which I talked about why microcredit, why and how it had come to be useful and convenient both for borrowers and for lenders. So the advantages it presented both to borrowers and lenders because of some critical changes in lending methodologies or in transactional technologies. Um, and then yes, in the 1980s and the 90s, there was the emergence of what was called the new consensus, which was focused on expanding the outreach of the organization and the attainment of financial viability of the lending institution. So really from the institutional viability from the lender's point of view. And also the third theme that we had discussed was how poverty came back to the international global agenda, the development agenda from the 1990s, and how this was a consequence of the critique of the structural adjustment programs and the market triumphalism of the 1980s. How this new poverty agenda now called for there was a renewed focus on the role of the state, what the state could do, what markets could do, and then what civil societies or civil society as a third important actor is supposed to do. So I talked a little bit about that. But specifically, my focus was on the embedding of microcredit in the global political economy of poverty reduction from the 1990s onwards. And here I talked about how the targeted interventions, poverty interventions of the World Bank became a means for the institutional dissemination of microcredit and micro enterprise credit programs globally. And this often happened through the incorporation of microcredit within the emergency social funds of the World Bank that was put together by the World Bank and offered as a package to liberalizing economies, primarily to contain political tensions and to make it possible for liberalizing regimes to survive, to perpetuate themselves. And then I think the last section was about the win-win hypothesis or the win-win claims around microfinance, which is that it addresses multiple claims, those claims being the empowerment of women, because the borrowers are primarily women, poverty mitigation or poverty reduction, because the assumption is that the poor are using the loans to finance micro enterprise activities and tiny businesses. And the third is lender viability. So the lending institution, whether it's a bank or a microfinanced institution or an NGO, remains financially viable and perhaps even makes profits, right? So that was the win-win sort of edifice on which microcredit became such a globally popular and celebrated phenomenon. So yeah, I think I'll take it from here. And this section is called microcredit as palliative relief or financial object, question mark. So this will be my first theme this evening. So is it looking at microcredit on the one hand as palliative relief and on the other as a financial object? So what I'm going to be doing in this section is to very briefly summarize scholars and theorists who have been trying to theoretically understand what is it that microcredit is and what it does in this new political economy of a renewed focus on poverty, right? So on the one hand, there has been, some would argue that there has been a strategic embedding of microcredit in the new global political economy of poverty reduction. And there is Heluas Weber, who uses the work of the political economist Karl Polanyi. And his work, just to very briefly go over that, his thesis of the double movement in capitalist societies. So he's talking about, once again, very briefly, the tendency that capitalism has to disembed the economy from society and governmental control, to take it away from, to abstract it from, in that sense, disembed the economy from social control, from societal control, by permitting the free market to self-regulate in the provision of a number of vital and essential goods and services, right? And this is public goods, basically. This is what Polanyi means. This is what he calls the first movement, when markets are when the economy itself is disembedded from society or from societal control. This is what Polanyi means as the first movement. This, he argues, creates a counter process of society's efforts to re-embed the economy within social and political control. So it's a sort of a dialectic second movement or a counter movement. Now, this can be seen, as more current theorists argue, like this, which is that the structural adjustment programs, the SAPs, can be seen as policy initiatives that correspond to Polanyi's first movement, which is to disembed the economy from society by allowing the free market to self-regulate in the provision of public goods, right? So that's the first movement. And this, in turn, has led to widespread backlash and resistance and people's anger at fiscal austerity programs that I talked about in the last lecture. And this sort of resistance, therefore, in a sense, becomes the second movement or the counter movement, right? Like the popular unrest in Bolivia in 1986 in response to the structural adjustment programs, like the IMF riots in many countries across the world in the late 1980s, right? So that is the second movement. So you can see the SAPs as representing the first movement that Polanyi talks about, and the popular resistance that it sort of unleashed as representing the second movement. So how do you then place, in this context, microcredit? So Weber's argument is that microcredit plays a dual function here. One is that it advances the goals of the first movement by extending trade in financial services at the grassroots. So essentially, the idea is that it creates and deepens and extends a market for microfinance, for financial services at the grassroots, at very, very local levels. In doing so, it extends or it advances the goals of the first movement. But at the same time, and that's not the end of the story, at the same time, microcredit acts as a political safety net because it also promotes and finances private entrepreneurship, thereby hoping to mitigate income insecurity, right? Or promote livelihoods or reduce income insecurity in the informal sector. So in doing that, what it does is to contain or to dampen the politics of the second movement, right? So that's, in that sense, it acts as a political safety net, and it's a political safety net. So it contains and disciplines the politics of the second movement. So it addresses the goals of the first movement and simultaneously contains and disciplines the politics of the second movement. This is one kind of theorizing. Then there is work from the Caribbean by another scholar, who's in her work looks at the Caribbean, in which public assistance or governmental assistance to the poor increasingly during the years of the structural adjustment programs or during the years of economic globalization has taken the form of state support for petty market operations, right? What we may call micro enterprise development. So the argument here is earlier, what used to be two distinct strategies that were aiming to overcome the crisis of capitalism. So, two separate or two distinct strategies. These two strategies being governmental transfer to the poor, which was one strategy, and the other was self-employment of the poor, informal self-employment of the poor. That was the second strategy. But these two historic and distinct strategies have come to be increasingly fused, right? Have come to be increasingly fused through the form of micro enterprise development as a safety net under globalization, right? So this is another kind of theorizing from another part of the world. In both of these forms of understanding, theoretically understanding microcredit, the emphasis is on microcredit as a form of palliative relief, right? So it's a sort of an antidote or it's a balm. It's trying to contain a crisis, etc. While this is one kind of understanding, other theorists argue that microfinance itself may be seen as a financial object that generates and sustains profit and capital accumulation. Okay, so that's another way of looking at microfinance. You see it as palliative relief, but then you also can profitably understand it as a financial object which is generating profit and sustaining capital accumulation. And the way this might happen is that microfinance institutions or these specialized financial institutions, in order to attract international investors, often charge their borrowers, their end users of their services or their borrowers, rates of interest on their loans that are even higher or significantly higher than what prevails in the formal financial sector, in the formal banking sector of their respective countries, right? So this has the effect of entrenching a two-tier system of credit in which the poor are marked out for higher cost credit, right? So that's the way in which you can actually see micro finance programs as a financial object in and of themselves. Now, also as part of this, we must understand that microfinance is celebrated by a large number of commercial organizations and bodies because it is seen as having dramatically expanded the frontier of formal finance downward, right? Downward in the direction of very tiny entrepreneurs, the rural poor, into remote rural areas, amongst small farmers. So in that sense, there has been a dramatic expansion, downwards expansion of the frontiers of formal finance. So, and the word often used you'll find in the literature is rural financial deepening. Deepening in the sense of offering a wider gamut of financial services to a broader clientele group, right? Broader than was hitherto available as clients of financial services. So basically expanding markets for financial services in rural areas. And like I had said in the last class, it is a set of transactional technologies, the peer group based lending, the modality of repayment, the structuring of loans, etc., that have enabled an opening up of this frontier or an opening up of this market. And the poor, therefore, who were earlier seen as uncreditworthy, right, as non-bankable, and therefore were largely fell under the radar of the formal banking sector and were historically excluded, marginalized, bypassed, neglected, right, are now seen, in the era of microfinance or microcredit, are now seen as markets of savers and borrowers who are waiting to be tapped, right? It's in that sense, a largely untapped market, but that is waiting to be tapped at the bottom of the pyramid. So you may have heard this phrase, the bottom of the pyramid also, which is associated with bottom of the pyramid marketing sometimes, bottom of the pyramid lending at other times. But essentially, it's almost always used in the context of seeing the poor, largely, whether it's the urban poor or the rural poor, as attractive and potential markets and as nascent markets in the sense that they are markets in the making, right? So this is one kind of theoretical understanding. The other is the second theme. So if you could just note this theme as dispossession by financialization. So I'll explain that, but the theme can be, the broader heading can be dispossession by financialization. So here again the literature is that largely from the 1970s, producers and sellers have transferred their search for capital accumulation from the sphere of production, right, to the financial sector. This is sort of what is implied also by financialization. So, in other words, capitalists have turned to, or the capitalist class has turned to financial speculations as a source of capital accumulation. And one of the key mechanisms here, or the instruments or the modalities by which this happens, is to expand and encourage consumption through indebtedness, right? So, debt based financing of consumption is very much part of how capital accumulation happens, has increasingly taken place from, let's say, the 1970s onwards. So I just want to make sure as I'm continuing that you can all hear me. I don't have my phone with me, so in case, can I hope...
we are doing all right, yeah.
Great. Thanks, Babs. Yeah. Because I don't know, my father took the phone away, so in case I suddenly lose connection or something, yeah. I'll just keep the message also open. So if you want to say stop, you can just send me a message. Yeah. So let me put it simply. The idea is making money in the financial sphere by lending money that must be repaid with interest, right? And the most rewarding form of debt to the lender is where the borrower or the debtor over borrows, right? And keeps on repaying the interest and not the capital, right? So this obviously leads to an ever increasing source of income for the lender until the borrower or the debtor is completely overwhelmed, finished off. So these financial mechanisms do not, and this is important, do not create new real value or new capital. They reallocate existing capital, and therefore they require ever new circles of borrowers, of debtors, to be brought within the system and to replace those who are being overwhelmed, right? So that's also a part of the understanding. So all of this is how financialization has been differently understood and interpreted. So financialization then has granted inordinate power to a predatory form of capitalism, which is for-profit lending. And let me, for instance, turn to David Harvey's work here, very briefly, of course. Harvey, as we all know, turns to Marx's conceptualization of primitive accumulation, which is describing the process of how wealth was transferred to an emerging class of capitalists to enable the emergence of capitalism in the West, right? During the very early stages, the birth of capitalism. And Marx has written extensively about how this was an inherently violent process that involved a mass dispossession of resources to enable this concentration of capital. It did mean historically the seizure of land. It included the slave trade, enclosing the commons, right? The commons, enclosing the commons, and then converting the commons essentially into private property, plunder, murder, loot, very rapacious forms of extraction. So all of this then has been part of primitive accumulation. So David Harvey's work, in his work, David Harvey discusses that this is an ongoing process, and it's not only a feature of, say, early capitalism, but he would rather use the term accumulation by dispossession, right? Because Marx has used the term in a particular historical period. So to speak about more or less similar processes, but in the contemporary context, David Harvey uses the term accumulation by dispossession, which is the way in which includes, once again, all these mechanisms of how land gets commodified, how land becomes privatized, how peasant populations are often forcefully expelled from land. So there is the expropriation of land from users, natural resource users, from peasant communities, and different kinds or different forms of property rights increasingly become private property rights. So it could be the commons, it could be collective property, it could be state-owned property. That becomes through different means exclusively privately owned property. And then the commodification of labor power as well, in addition to the commodification of land. Also, the increasing elimination or the suppression of alternative forms of production and consumption. It could be indigenous forms of production and consumption that do not operate on capitalist principles. The slave trade, which can also continue in different forms, and Harvey also includes usury or the credit system as a radical means of primitive accumulation. So this could mean, for instance, through speculation, credit fraud, or even the debt-based financing of global South countries by global North countries that leads to countries in the global South just eternally repaying interest on loans taken from financial institutions based in the global North. And this is something we had talked about earlier. So there's just one more definition, another definition of financialization that I want to add. If you'll just wait, it's yeah. Yeah, sorry, this is in my laptop, and I didn't realize that I had this. I couldn't integrate it with that. I just realized only now. So Silvia Federici's work, in which she talks about how a debt-based economy has been instituted as an essential part of neoliberalism, as an essential part of neoliberal strategies, and what that means is it's of course dismantling of the welfare states in countries of the north that had more vigorous forms of the welfare state than South Asian countries have ever had, or many parts of the global South have ever had. So on the one hand, it has meant dismantling of the welfare state, but also it has meant what she calls the financialization of reproduction. Right? What she means by that is that an increasing number of people, this could be the elderly, it could be pensioners, students seeking loans to finance their studies, etc., have been forced to borrow from banks, from financial institutions to purchase services, healthcare, education, higher education, pensions, that the state formally subsidized, right? So the idea here, therefore, financialization of reproduction is because this entire domain of reproductive activities have become immediate sites of capital accumulation, right? Or these were activities that, under a different social understanding, used to be, if not completely free, then used to be heavily subsidized and supported by the state. But now these activities have become sites of capital accumulation and profit generation, and different subsections of the population are turning to banks and various kinds of financial institutions to finance their needs for education, for training, or even their inability to live now. They just need to consume through debt financing. So that's what she means by the financialization of reproduction. So I thought that I'd sort of just go very briefly over these concepts, different ways of understanding it, before I got into the specifics of microcredit itself. So this is like a sort of a broadly understanding the debates around how microcredit is embedded in this new economy. So I thought maybe at this point I can take questions if there are any, and then I can move on. So,
Okay, any questions so far? Jayashree had a
I had
question.
one, Kalpana.
I can, yeah, sure, I can hear you, Jayashree.
I mean, this whole debt-based economy, the loan-based economy, consumption-based, debt-based consumption. That is the term that
Yeah.
you're using. That 1970, it was a phenomenon in India also. No, it was more the West.
No, it was more the West. It was more the West, and I
Okay.
would say that this is sort of I mean, one way in which this was also taken, carried forward, or advanced within third world countries was through the structural adjustment programs, right? So, if you remember one of the earlier sessions, I talked about how there was an aggressive financial liberalization of third world economies that was part of the conditionalities of the structural adjustment programs. So that was definitely a case, something that we do see happening in third world countries as part of the SAPs. Yeah.
70s itself. So it's more the countries borrowing rather than the individuals in the economy. Like unlike in the West, in India, people have not started
Oh
debt-based
yes,
consumption.
they have. The middle
Country.
classes have. The middle
Okay.
classes have. Those classes that
Oh.
can, for instance, afford to have and use plastic money, for instance, right? Who are part of
Okay.
the whole credit card economy, in which you're
70s,
essentially
1970s.
no. So that's what I'm saying. Now it has. Now, from the point of view of where we
Now
are,
it is. Yeah.
now it has. That's
Yeah.
what.
Yeah.
That's
Yeah.
what.
Yeah.
Yeah.
Hi, Kalpana. I had a question also.
Sure, Shreya.
There was one bit I missed, I think, or I didn't grasp. You were
Yeah,
talking
yeah,
about financialization, not
yeah,
not Federicis of reproduction earlier when you're talking about dispossession by financialization.
yeah.
You said at one point that this something becomes an ever increasing source of income for the lender. That is one thing I think I missed.
Don't
Something
worry. I'll go over it again. Yeah.
around that. And also another point, you said something about financialization granting
Yeah.
enormously
I'll go over that section
huge
again. I'll
power
go over that
to
section. Sure.
capitals.
So this is the way in which it's understood that earlier, while product profits would be made through, say, actual activities of production, now profits are being made increasingly in the financial sector through, say, financial manipulations or financial speculation, and then through the indebtedness. I mean, consumption, but through primarily by turning people into debtors. And one way to make money in the financial sector is, of course, to lend money that has to be repaid with interest later, right? So it's essentially the relationship between the lender and the borrower, and and here what actually works in the interest of the lender. What is the most rewarding form of debt to the lender is the kind of debt in which the borrower is only repaying the interest, right, month after month, and is not in a position to ever repay the loan principal of the whatever of what was borrowed. So this is what is meant by ever increasing income, because often then we've heard of credit transactions in which the interest itself is sort of eclipsed the amount of the earlier loan that was borrowed, and and therefore that is the most rewarding form of profit making from the point of view of the lender, right? Because the borrower then is completely decimated, is overwhelmed, right? So, but you need therefore to find new circles of or new groups of borrowers, new groups of debtors, for instance, who must be brought within this, so that, because when one class of people or one section of the population is completely overwhelmed, then or individuals, even as individuals are overwhelmed by this system of constantly repaying just the interest alone, then you need to find replacement, right? You need to find ever widen this circle of borrowers. So this therefore gives a lot of power to what is seen as a predatory form of capitalism, which is for profit lending, right? Lending for profit, in which there is actually no real wealth creation or no real new capital that is being created, but there is a reallocation of capital. So it's sort of flowing from individuals who are being indebted, losing their assets, etc., to individuals who are at the other end of the spectrum. So this relationship then is what I was talking about as an important, and there are ways in which you can see this relationship play out between individuals. You can see it play out between nations, etc. So yeah.
Yeah, thanks a lot.
Sure,
It's very
sure,
clear.
sure. So any other questions, or do I continue?
I think we should continue.
Sure. So the third section, we can call this the review of key findings on the Grameen system or Grameen model of microfinance. This is the heading of the third section. This is the focus in this section is going to be the experience of microfinance programs in the 1980s and 90s largely, just to give you a sense of that history in Bangladesh. Why Bangladesh? Uh, Firstly, Bangladesh, because it has been home to some of the largest, oldest, and best known microfinance institutions that are explicit, that sort of claim that they are poverty targeted. That is to say that even in their membership, they insist that there be a sort of a definition of who can be members, and that is usually linked to some poverty criterion. Those who own land that is tiny, right, and therefore become eligible as the rural poor or as the nearly landless or as marginal landowners to be part of this microcredit program, this anti-poverty intervention. So these are poverty targeted MFIs because there can be microfinance institutions that are not necessarily poverty targeted, right? So Bangladesh, being home to some of the largest, best known poverty targeted microfinance institutions, has also attracted a great deal of international attention, but also research. Right? A lot of the critical research is also based on microfinance, based on the experience of Bangladesh's microfinance programs. Also, the scale of microfinance and microcredit programs in Bangladesh is very large. What has happened in Bangladesh was, and that had happened even by the 1990s, the formal financial sector, which is their commercial banks, agricultural banks, were pushed to third place, right, in terms of the amount of credit dispersed each year. The first place is usually always the informal sector, right, which is borrowing from money lenders, from friends, from people you know. So the informal institutional sector. The second place was taken by the NGO and MFI sector in Bangladesh. So this is just to give you a sense of the scale of operations of the microfinance sector in Bangladesh. Now, in Bangladesh, the focus usually is on the Grameen model or the Grameen system, right? Not so much only the Grameen bank when you look at this research. Why is that? Because the Grameen model has emerged as a dominant or hegemonic model. And there are, for instance, there were by the end 1990s or so, the late 1990s, about over 10 million users of the Grameen system in Bangladesh, but only 3 million were clients of the Grameen bank directly. So, what that means is that many large MFIs in the non-governmental sector were replicating the Grameen model, right? The Grameen Bank's model, and that made it possible to speak of a Grameen system. For instance, BRAC, which was another large player, BRAC, Proshika, ASA, these were all in the non-governmental sector. And then Bangladesh government had its own microfinance programs, the RD12 as it was called, and the TRDEP, all of which were again based on the Grameen model. So we may speak of a larger Grameen model. And by the mid to late 1990s, the leading players in microfinance in Bangladesh had designed and were running programs that were practically indistinguishable from each other, right? With some very minimal differences, these programs were very, very similar. So there was little by way of alternative program design that was being offered to clients and borrowers. And there was, for instance, to also explain this a little bit further, the Grameen Trust that was set up in order to provide financial assistance and technical assistance to Grameen replicators, right? So those who sort of replicate the Grameen model. So that received support from the Grameen Trust, and the Grameen Trust was supporting 70 projects in 30 countries in Asia, Africa, Europe, and the Americas, right? So pretty much global by the year 2000. And this included developed nations such as Canada and the United States, right? So microfinance is seen as this sort of development model that was being transferred from a third world country to first world nations. So, and they were prominent at that point of time, prominent global institutions such as the IFAD, the International Fund for Agricultural Development, the Asian Development Bank, that were willing to support microfinance projects and programs only if they were based on the Grameen model. So it had become, by the 1990s, mid to late 1990s, this blueprint, right, for best practices or for the most successful microfinance model. What was therefore the structure of this model? If you looked at the Grameen Bank itself, there were small borrower groups of about 5 members each at the primary level, at the village level, that were then integrated into 6 to 8 such groups that were called centers or kendras, right? So this was there. This was at the centers and kendras functioned at the level of the village. And both these 5-member groups and the larger centers and the kendras were separate for women and separate for men. And members were required to deposit weekly savings, compulsory savings at regular weekly meetings with the sponsoring MFI, the Grameen Bank in this case, if it was the Grameen Bank. The MFI in turn would on-lend funds, subsidized funds, that it had to the borrowers, and these funds it had sourced, usually it would source from the Central Bank of Bangladesh or organizations that were called microfinance wholesalers. So essentially these were organizations that would lend to, not to the direct client, but to microfinance institutions like the Grameen Bank, right? So they were called microfinance wholesalers from other donors, right, and from borrower savings. So all of this would constitute the pool of funds that would be on lent to borrowers. And usually this was subsidized, in the sense the funds were subsidized for the Grameen Bank, for the MFI. It was sourcing these funds at subsidized rates. The repayment was in about 52 weekly installments in a year and collected by program staff generally. That was the interface. There was no physical collateral, but most programs insisted on deducting a certain small percentage of the loan that was given out to each borrower as the borrower's contribution to a security fund or a group fund, right? So that was a sort of a deduction as when the loan was given, and this was a borrower contribution. The financial resources of the group were controlled entirely by the staff of the MFI, and the terms of lending, which is how much do they save, what is the rate of interest, in how many months or weeks do they repay a particular loan, the loan packages, etc. All of this was standardized, right? And it was determined by the MFI, right? So this was the basic structure. Now, what happens is that from the 1990s onwards, there was increasing pressure on MFIs such as the Grameen Bank and the many other MFIs that were part of this Grameen system, right, to achieve financial self-sustainability as a lending institution, because that's the legacy of neoliberalism. We talked about this. The development agent also has to be financially viable and financially sustainable. So, repayment performance of borrowers and the viability of the lender became key markers of program success, even amongst the poverty targeted MFIs. Okay, this is important to keep in mind, because some of the unintended outcomes of this were that certain program features that aimed at ensuring institutional viability or lender viability also worked against the interests of very poor borrowers, or very poor sections among borrowers. For example, to give a couple of examples to make this clear, the MFI was under pressure to expand its scale of operations. It was called upscaling, because one way you contain costs and achieve financial sustainability is to also grow, right? So to upscale is to expand its scale of operations, to increase. So one is growth to new borrowers, new villages, new population groups. The other is to simultaneously increase the number of loans per borrower, what was called credit deepening. Okay, and then of course to increase interest rates, and then to tighten repayment pressures. Right. So these were all part of the program level changes that reflected these imperatives. So therefore, the lending terms and loan packages of MFIs were also changing in the 1990s, as many researchers have observed. These It also meant that larger loan sizes would be offered to borrowers than was the case earlier. So this made the program more attractive to better off sections in the rural population who may have self-excluded themselves, right, from the program, because when loan sizes are very tiny, then they are seen generally as being more suitable for the very poor sections. They're simply not attractive enough for better off sections. But larger loan sizes also attracted better off sections to the program and induced the participation of those among the rural poor or rural population who may have kept away from the program earlier. So there was a sort of a changing socio-economic composition amongst the borrowers, or the profile of borrowers, that also class profile of borrowers that did change over a period of time. And also these pressures for quick repayment, for repayment, essentially repayment discipline and pressure, made it economically unviable for the institution, the lending institution, to work with the very poor. Now, the microfinance literature uses terms like the core poor, or the poorest of the poor, or the absolute poor, which is to say that those among the poor who are pretty much at the rock bottom. So the program then also has a disincentive institutionally from working with core poor sections, from explicitly targeting core poor sections. But to sort of understand this credit deepening that I talked about, which is to increase the number of loans per borrower, it was seen that MFIs put poor borrowers' households on a treadmill, increasing, growing treadmill of loan size, without enhancing the capacity of the household, to the borrower's household, to productively absorb the loan. Right? So giving a loan is one thing, but then you don't, what about the capabilities or the capacity of the household to make productive use of the loan? Right? That's another different thing altogether. So this meant that when, as a consequence of this treadmill of borrowers going from a smaller loan size to a larger loan size, it often led to borrowing from informal lenders to repay the MFI, and then much of the MFI's loans would go back to to money lenders. So there was this, and there were some ethnographic studies that also spoke of how money lenders would even accompany women on their weekly visits to the loan center, to the branch, to the local branch, etc., to make sure that when she got the loan, the money lender's debt was also repaid. So this was called, this juggling, was called cross-financing from the informal sector to the MFI sector, back to the informal sector. And this cross-financing, for poorer households especially, meant that they were managing repayment without the actual capacity to repay. And this can lead to the collapse of very poor households. Also, as part of these changes from the 1990s, these viability pressures, repayment pressures, programs that earlier were more integrated in their approach, that included other facets of community development, like, for instance, adult literacy or health, a package of health programs or health services or other community development services, tended to focus increasingly on a minimalist credit-only approach as a way of keeping costs down. And ASA, for instance, was one organization which moved from organizing the landless, adult literacy, offering health programs, and to increasingly focusing on microcredit, to the extent that other programs were marginalized by microcredit. So this is one kind of sort of one set of observations about how these programs changed. Another is also spoke about a tendency for the program design itself, right, within this Grameen model to be rigid and inflexible. What that meant is that repayment usually was supposed to start from the very first week after you received the loan, which meant that you couldn't actually wait for a new enterprise to yield some kind of income and then you repay it from that income. You must have an accumulated savings stock in hand to be able to repay the loan if you're going to have to repay from the very first week onwards, right, or the next week onwards. So, also, many occupations of the poor, many livelihoods of the poor do not generate weekly incomes, right? And yet, the way repayment was structured was that every week, in so many weekly installments, the loan had to be fully repaid, which meant there had to be repayment almost on a weekly basis. Um, the other was that most MFIs, at least when they stated borrowing purpose officially, gave loans only for enterprise purposes. So even when borrowers were borrowing for a wide variety of consumption related needs, such as just food or house rent or um, a number of other consumption needs, they had to disguise their actual borrowing purpose, because the stated purpose of the loans was the enterprise purpose. So this overemphasis on lending for enterprises, or micro enterprise lending as it was called, overlooked the reality that not all the poor had or managed income generation activities for which they needed to invest micro credit, right? So obviously that was not the case with all sections of the poor, and yet this was part of this rigid program feature and part of the assumption of the program itself. The other sort of critique has been to look at the credit packages, the loan packages that were standardized, largely short-term working capital loans with, once again, inflexible repayment schedules that did not take into account seasonal fluctuations in the livelihoods and incomes of borrowers, right? So it was that was so in other words, it was a centralized, standardized, top-down, supply-driven model of microcredit delivery. Okay, so this was broadly the critique. Savings again, where the poor could not access their own savings, and in this system, and there was no easy access to emergency loans, even if there was a household emergency of some kind, or one kind or the other. So, to sum this up, there was a mismatch between what was being offered by these MFIs, which was a homogeneous product package, and what the poor needed because of their diverse, varying needs of poor borrowers and households. Okay, so, and this is also the reason the microfinance industry was called a limited product industry. So, what is important to note here is that these features, right, this standardized, centralized, top-down model, made it easier for the staff to operationalize the program. It reduced operational costs as well, but it made the microcredit project itself a harsh terrain to negotiate for the poor. Um, So, and therefore there has been writing from Bangladesh. Oh, sorry, was there a question? Okay, no, sorry, I think this was an older question by Jayashree, not now. I think this was an older question. Yeah, okay. So,
I just asked one question.
yeah, sure, Jayashree.
How come there was no? I mean, see, from what you're saying, it seems like a very heartless kind of a, I mean, Shylock kind of a lending instrument that has been very, very carefully designed and put in place. But it is totally heartless. How can there be? How did the state allow it? I mean, how come there is no regulation against it?
So,
I
see,
mean, it's clearly
yeah.
unethical.
No, see, the thing is that it was not seen as clearly unethical. It was not perceived like that, right? So let me explain that. See, where the state was concerned, for one thing, the state was pretty much absent really in the sector. I mean, the state was, once again, if the state had been doing its job of meeting the credit needs of the poor, then you don't even have these MFIs developing. For another, it was not clear from the beginning that this is what was happening. No, you had the BRAC and then you had the Grameen Bank first emerge as sort of alternative, innovative models within the non-governmental sector. And then they they expand in size. And by the 1990s, they become, or the late 80s, they become these large established players. It takes a while also for research to catch up, right? For us to understand. So there is that inevitable time lag between the way these programs are shaping up and then for researchers to understand that these are very important defects in the program or associated with this model of lending. So that was certainly part of the story. The other part of the story also has been that there were, and I mean, this is part of what I'm also going to continue. I'm sort of still in midway through the story. But there were efforts on the part of the Grameen Bank to represent itself, to remodel itself. That happened later in 2002 in response to a lot of criticism of the Grameen Bank. But I'll come to that in a while, Jayashree. I mean, I'm sort of only midway through this, so I'll add a little more detail and then I'll come to the efforts of the Grameen Bank to remodel itself. So,
Arul had a question. Arul, please.
Yeah, sure. So here, Arul, informal institutions, it was the volume of credit because the particular parameter that I'm looking at was the volume of credit that was being disbursed, but also possibly the reach, simply the reach of local suppliers of informal finance, no, like local lenders, the local lending sector, whether it's the local shopkeeper who's a lender, or there's a professional money lender, or there's a school teacher who's a lender. All of that becomes part of your informal financial lending source. But that particular data that I was looking at was on the basis of the amount of credit disbursed on an annual basis. Yeah.
Okay, we can proceed. Yes,
Okay, sure. Yeah. So, so then, therefore, microfinance then, based on the experience of the Grameen model, but also from other parts of the world, came to be increasingly critiqued by researchers as a limited product industry with high rates of client desertion. That is to say that borrowers would vote with their feet. No, it's called voting with your feet when you just walk out of programs. So there's you're just abandoning the program because it doesn't meet your needs anymore, right? So on the one hand, there was desertion by borrowers. On the other hand, there was also this limited capacity of the program to reach the poorest sections of borrowers. So people would speak of the growing breadth of the program, but the depth as in its capacity to effectively or meaningfully offer services that would be attractive to very poor sections was quite limited. So you also have, as part of the story, something else that I must draw your attention to, which is the structurally asymmetrical, unequal relations of power between the staff of the program and the borrowers, right? And this probably came through also earlier, but I want to focus on it a little bit because, and this comes essentially because borrowers are not involved in crucial policy and operational decisions, right? Of who gets loans, how much is the size of the loans, how is the repayment to be structured, what is the duration of repayment, what are the interest rates. So these crucial operational decisions are taken not by borrowers themselves, right? And so this therefore means that effectively meant that power and authority within the program were concentrated with project staff or with the local level MFI staff. They controlled financial resources of the organization. They monopolized accounting information. Obviously, the borrowers had no idea of the flow of accounts and the accounting information. They would decide who would get a loan, how the loan would be repaid, etc. And this also meant, so the structural asymmetry in this relationship between the project staff and the borrower on the one hand, and on the other hand, something I talked about, which is the growing pressures from the 1990s towards financial viability, right? So of the organization. So both of this come together, and what it effectively meant was that field staff would engage in increasingly punitive repayment strategies, right? So, such as starving other members of loans or cutting off other members' access to loans unless a particular defaulter paid up or somebody who was delaying a loan paid up, right? Then nobody else gets a loan. So, these pressures then, and not only at the level of the 5-member group, but at the level of the larger Kendra, the 40-member center or the Kendra, for instance. And the seizing the property of the defaulter. So all of this then becomes increasingly common within these programs as a combination of these features. Also then, among borrowers, eviction of the poorest members from the group is an act of self-protection by the others because they see the very poor or the core poor as a poor credit risk, right? And because of their inability to repay loans, others don't get loans. But sometimes it's not only the poorest, it can also be members who are undergoing a temporary income shortfall. That is to say that there can be a financial crisis in somebody's household. There has been a collapse of a livelihood, the loss of a employment, the failure of a harvest, a cow has died, right? So some form of crisis, one form of crisis or the other, but that person therefore goes into a temporary income shortfall and is then perceived by the rest of the group, by her peer group members, as a liability, as a bad credit risk. So there is also then coercive intra-group peer pressure. For instance, there was a documentation of how co-members pulled down the house of a member because she defaulted on her housing loan from RAC. So these were all cases that ethnographic studies revealed. And then there was also the Grameen suicides in the late 1990s, which is unable to face co-members and repay loans. Some families, some individuals, borrowers also committed suicides. So researchers then were asking, even by 97 and so on, researchers were asking, are microcredit programs protecting the poorest or are they disciplining the poorest? So is it about protection or is it about disciplining? And then, of course, studies were also showing that these repayment pressures also had adverse effects on the stress coping strategies of poor members or all members. So it would mean that households would consume less vegetables and meat because of repayment tensions, or they would sell household assets in order to be able to manage repayment deadlines. And or they would postpone essential consumption, treatment, medical care because of loan repayment deadlines and the fear of missing a deadline. So it would, in a sense, worsen or have an adverse impact on the stress coping strategies of members. So for all these reasons, another related finding was that the poorest tended to self-exclude themselves from these programs because they saw these pressures and they felt that this program would not address their needs. And this was particularly disturbing when microfinance programs had also begun to link other services to their microcredit delivery. So, for instance, they would link health services to microcredit, or they would link educational services to microcredit. So, through interlinked structure. So, once they create a sort of a grassroots structure for the delivery of microcredit, that became a very convenient instrument, organizational structure at the grassroots for delivering other services. But this meant that the poorest of the poor, then, who had self excluded from the program, from the microcredit program, may also not receive these other services when actually they may have needed them the most and they may have wanted them as well, right? So these were the pressures that I sort of wanted to briefly highlight. Questions at this point? Any questions at this point, or shall I move on?
So the rationale for the Grameen Bank to come up with this women-based model,
Ah.
it now or
No. We are not. We are going to get into that uh, completely in a different lecture. So that's why I'm not even using the word women. The one thing, though, since I have talked about this, I can say here is that um, also, in addition to structural, I mean, to operational and policy decisions being with the line with the MFI staff and not with the borrowers, you can also add the gender dimension of how the MFI staff are almost, largely, especially the branch level, the Kendra level staff are largely male and the borrowers are largely female. So it's also that gender dimension that gets added on to the way these programs are implemented. But then, I don't want to say anything more at this point because how and why did women then come to be incorporated, and then how does gender play out? That's a separate lecture where I'm going to go into that, and I'll bring it all together. So, one thing I should probably also add here, which is in 2002, under pressure, and also because there was a lot of reporting in the international press on the Grameen suicides, right? And I think UNIS was concerned, and the Grameen Bank's board of governors was concerned. So in 2002, they introduced what was called Grameen 2. They actually called it Grameen 2, and they set and Yunus in his statements introducing Grameen 2 spoke about how different it was from the classic Grameen model. So many of the features that I've told you have been the classic Grameen model, right? And Yunus talked about how now there was greater choice and greater flexibility within the program, and how Grameen 2 was therefore about microcredit with dignity, right? Because it was really the loss of dignity of the borrower that also came up. It's not that every borrower was at risk of suicide, but also this sort of loss of dignity. So the microcredit with dignity was how Yunus had described Grameen 2. And when it was rolled out. But then I have not come across any sort of field studies that have looked at whether the Grameen Bank actually at the grassroots substantially altered its practices when it formally adopted Grameen 2. Right? I haven't come. There must be something, but I haven't come across that. So I can't give you a sense of whether that meant that at least the Grameen Bank had rehauled its model. But in any case, as we know, the Grameen Bank is now, it's a system, it's a model that is hegemonic, and it's not just the lending practices of a single institution. So, yeah. So shall I continue?
are there any other questions? Okay, I think.
Yeah, I'll continue, Babs.
Oh,
Pooja,
one.
yeah.
Pooja, you can speak also. We can hear you if you are speaking.
I can't hear Pooja. I don't know if she's saying anything.
Let's wait.
Yeah, she's probably typing. Ma, Veda Veda and Tandi Tada.
Puja question is prepared.
Can self-help groups be understood as similar terms? No. Pooja, they can't be understood. The MFI groups structure is very different from the self-help group structure. The MFI groups are, in fact, they are called the joint liability groups or the JLGs. And then the self-help groups of India, which is an Indian innovation, have a very different structure. And I want to sort of wait for us to go back to the Indian section, because when I pick up the India microfinance story again, one of the first things I'll do is to talk about how different the self-help groups are from the Grameen model, the joint liability groups. Yeah, so they are different is what I can say now, but I'll go into that difference at great length a little bit later. So I'll continue then. So the fourth theme, you can notice as the fourth theme is enhancing incomes to mitigating risk, a shifting discourse. So what I mean by this, enhancing incomes to mitigating risks, a shifting discourse, is in this section, I'm sort of going to be focusing once again on after microcredit became an important part of the anti-poverty interventions, development interventions globally, how has the framing of microcredit also been changing in response to critical research findings about microcredit? So that's what I'm going to be focusing on in this section. So another key finding, so all the earlier findings you could say had to do with the organizational design of the program features, etc. But another key finding was that credit for micro enterprises, right, or micro enterprise based credit was not appropriate for all sections of the poor, and it was certainly not appropriate for the poorest. Okay, this was another emerging consensus from the research material, from the research that was looking at microcredit programs critically. So you have, for instance, Hume and Mosley, Paul Mosley and David Hume's study of 13 microfinance programs, not just Bangladesh, so globally, and it's a book that came out in 2 volumes called Finance Against Poverty. And they emphasize the differential capacity of the poor to make productive use of credit-based, credit-financed enterprise opportunities, right? So the idea is that not all the poor can use microcredit to finance micro enterprises and then to pull themselves up above the poverty line. If you remember, some of this criticism will be familiar to us because I talked about this when I was talking about the IRBP as part of maybe the second lecture, and how some of the assumptions of the IRBP, that all you need to do is to provide a poor person and her household or his household with a loan. That's enough, really. That's in itself an effective anti-poverty intervention. That understanding and that assumption was challenged, right? So you're going to sort of hear an echo of those arguments in this section. One of the findings, for instance, is that even those sections of the poor identified as below poverty line sections are heterogeneous. It's the upper sections of the poor who are able to seize enterprise opportunities and to use them profitably because they have assets. Some assets may not be very much, but some, even if limited, they have therefore asset means some cushion, right? A fallback option. They have the capacity to bear risks. They have slightly better literacy skills. They have connections. They have access to information. So all of this means that their capacity of the upper sections of the poor to use micro enterprise credit is definitely going to be quite superior to the poorest of the poor. So, as the Hume and Mosley study and many other studies also demonstrated, initial life circumstances are a very critical factor that explain the success of micro enterprises. So it's the core poor who face the greatest risk of enterprise failure. It is the core poor or the poorest of the poor who are most severely affected by what is called downward descent. That rather than upward mobility, it's downward mobility, right? So it's they who are at the risk, the greatest risk of downward descent. Um, and micro enterprise loans are not always effective anti poverty instruments. So, here what we see is that in the 80s and 90s, the microfinance sector itself was dominated by a narrow understanding, narrow conceptualization of microfinance as micro enterprise credit or credit or lending for income enhancement through financing enterprises. It was also called, another word for it was promotional credit, basically promoting incomes or income enhancement. So most poverty, what we must keep in mind is that most poverty strategies tended to be promotional in nature during the 1980s, because that was really the neoliberal era, when, for instance, there was an emphasis on the workfare state rather than the welfare state as well. So that's another kind of discourse that was becoming prominent at that time. Um, and as research showed, the potential of microfinance to help the poor would have been better realized if protectional dimensions of credit were more, if had been more effectively tapped. So essentially, the criticism was that rather than assuming that what the poor need is micro enterprise credit, and therefore lending must always be geared towards income enhancement or promotional lending, perhaps if the focus had been on protectional lending, then that would have yielded better results. So, what do we mean by protectional lending? Which is to the kind of a microfinance program that prevents the incomes of the poor from falling below a certain threshold level. So it's no longer climbing up through enterprises, but it's about preventing the incomes of the poor from falling below a certain threshold. So it's therefore called protectional lending. And strategies that are protectional, what examples? For instance, giving the poor access to their own savings. So whenever they want to easily withdraw savings from the program because there is a need for savings, they are able to do so, right? And then giving them consumption loans. It's not tying loans only to enterprise purposes, but giving them consumption loans as soft loans, right? Especially during emergencies, giving them easy access to emergency loans, giving them access to insurance services. So a wider spectrum of financial services would have helped to tap or mobilize the protectional dimensions of credit better than had been the case in the era of promotional lending. So that was the sort of whatever wisdom that came with research. Also for core poor sections, protectional lending would have helped better because it would have smoothed income and consumption fluctuations. That is to say that fluctuations in whenever incomes fall below or for some reason there is a inability of the earnings of a household to meet its current consumption needs, right? Then you need of just needs like rent payment, education, school fees, food, survival, medical care, etc. These are all essential consumption needs. Then you need access to finance for what is called consumption smoothing, right? Or smoothening. That's the term used. So this could have strengthened the coping strategies of the poor during a period of crisis. So all these critical research findings have been feeding into the dominant representation of microfinance within the global development industry. Okay, so that's important. So in one of my papers, what I did was to see how these changes were reflected in the World Bank's World Development Report of 1990 on poverty and the World Bank's World Development Report on 2001, which was called Attacking Poverty. Okay, so there was a theme, poverty theme, 1990 and then 2001, so a decade's gap, and the way in which the World Development Report of the World Bank conceptualizes microcredit and frames microcredit shifts fairly significantly between these two reports. So how was it in 1990 in the World Development Report? Microcredit is part of Chapter 4 of the World Development Report, which is of 1990. The chapter is titled Promoting Economic Opportunities for the Poor. So the uh, uh, increasing credit access of the poor is seen as and presented as a strategy to increase and enhance the participation of the poor in growth processes, right? So increasing access to credit alongside increasing access to land or infrastructure or technology to enhance participation of the poor in growth processes. So microcredit then is talked about as a successful strategy in reaching extremely poor sections, and micro enterprise lending is reported or is described as having had considerable impact on the income levels of the poor. This was the 1990 World Development Report Poverty. Now, the 2000-2001 World Development Report, there is a clearly discernible difference in the representation of microcredit. If you looked at even the theme of the commission study on microfinance for the WDR 2000, because usually there is a commission study that sort of undertakes study and has a fairly extensive report, and the findings of that report are then synthesized within the World Development Report, right? So if you look at the theme itself, you can see the theme was impact of microfinance on selected non-income dimensions of poverty and on how people use microfinance to mitigate risk and reduce vulnerability. Okay, so this is the theme, right? Now, the World Development Report 2000 was divided into three sections or three interrelated fronts for action against poverty. And these were called empowerment, opportunity, and security. Security. And microfinance was placed in the section on security. Okay, so it's not so much a growth strategy, it's a security strategy. It's a policy, it's talked about, it's represented, it's described as a policy response for improving risk management. Okay, alongside health insurance, unemployment insurance, old age pensions. So that's where microfinance is actually placed. And it's characterized in the WDR 2000 as a household level risk management tool. Okay, it's an important seen as an important part of household money management strategies when households are trying to manage various cash flows, and often they are juggling between cash flows to survive. Microfinance is seen as playing an important role in enabling the household to manage its money, and also to not collapse during a period of crisis, and to protect itself from selling its assets during a period of crisis. So that's basically, so it's helping smooth consumption during a period of shock or crisis by preventing the distress sale of assets. And the report, the WDR 2000, acknowledges that microfinance has had a limited reach to very poor sections. It's not worked at all there, and that it's largely worked with the moderately poor, not the very poor, but the moderately poor, or those above, just above the poverty line or just below the poverty line, not very much below the poverty line. So it's fairly explicitly stating this is what the findings have shown us. So I just want to add this point and then I'll open it up for discussion, which is that the WDR, or I was not in that paper, arguing that microfinance is no longer central to the anti-poverty discourse. I was not arguing that. What I was arguing was that while income enhancement capacities or income promotion capacities of microfinance were found to be limited, microfinance has become central to vulnerability reduction and risk management concerns. Okay, and this has happened at the same time that vulnerability reduction and risk management have themselves become central to the poverty discourse or to poverty concerns, right? So we know, for instance, that safety nets and vulnerability reduction, all of this became important during a period of uncertainty due to global financial flows, the risks and shocks brought on by globalization, etc. and the agenda of protecting individuals and households has moved to the forefront of the poverty discourse at the same time as microfinance is being located within the agenda of vulnerability reduction and risk management. So that's what I was trying to, that's the argument I was making. Of course, a parallel development during this period has also been the shifting conceptualization of poverty itself, which has changed from during the 1990s from a narrow income poverty understanding to of poverty as a static condition to a more comprehensive understanding of poverty as a dynamic process. Right, that poverty is no longer only about low incomes, and it's not a static condition. It's really about a process that is constantly in fluctuation. That the poor are vulnerable to unforeseen, unpredictable changes in income flows, and poor households have always been vulnerable to downward mobility pressures. That understanding, therefore. They do not possess stable incomes or stable consumption standards. But that the incomes of the poor fluctuate all the time in ways that are only partly predictable. Okay, so that's the sort of more or less more evolved understanding of poverty itself during the period that the representation of microfinance has also been shifting within the dominant development industry. So I'll stop with that for today. This is what I have today, and then I'll open it up for questions. Yeah.
Thanks, Kals.
Sure, Babs.
Any questions?
I can also send all of you two of my papers, both of which are very directly related to what I've been talking about today. So whenever you have time, you don't have to read it for the next class or anything. Whenever you have time, you can take a look at the papers. And one is, and in one paper, it's enough if you read just half the section, because that's the half that I've actually talked about. The other half I'll talk about later, so you can read that later. But I'll make that clear in my email. So thanks, Jayashree. Thank you. Yeah, certainly I'll send my papers. Certainly. Yeah. And like I said, anytime, it's not for the next class or the class after. Anytime you have some time, you can take a look at it.
I was wondering, just for the historical sense, this changing conceptualization of poverty itself
Yeah.
and the changing role of microfinance,
Yeah.
both were independent of each other, or they had anything to do with each other? I mean,
So I think they were, I mean, it's kind of, to an extent, these understandings were always, they always flow into each other. Yeah. Because that's also the way in which a lot of research happens, and the way people write commission papers, reports, and academic papers, that at some level they may have been related, but not at a direct level. For instance, I would say the change in conceptualization of microfinance was prompted by largely by sort of very studies from the ground. A lot of research can be ethnographic. Sometimes it was largely quantitative database. But that was saying that micro enterprise credit is not what the poor need. It's not working for all sections of the poor. That rigid program features are not working. So a lot of the critical research would have prompted the change within the microfinance industry, right? In a sense that microfinance had this sort of very ambitious claim earlier, but then those claims are sort of tempered and toned down. But that is in response primarily to the research findings. As it happens, I won't say closely related, but sort of interrelated understanding is the understanding of poverty itself that is then being looked at. So yeah, I would see it like that.
any other questions?
If somebody else has a question, I am not asking.
No, please go ahead, Jayashree.
My question is actually, Kalpana, the thing is, I mean, I am a student of science, so, I'm just a bit puzzled. Like, when you are actually introducing a certain radical instrument into the society, would want to do some kind of a, you must have some understanding of the efficacy of it. It's not like as so completely you are engaging with a very very unknown space. The economic space is fairly well known, and there are people who have been studying and kind of saying things. So how is it that one couldn't forecast, one couldn't foresee these eventualities that happened with microcredit?
Uh, because I mean that would have been difficult to forecast. Jayashree, no, I think it was Jayashree's question, right? Yeah. So I think that would have been. I mean, I would not. It would have been difficult to forecast. Many of these were what we also call unintended consequences or unintended outcomes of these programs. I mean, for that matter, those who are supposed to be in charge of planning larger things about the economy, for which there are trade cycles and economic cycles and histories, right? Of this is how these trade cycles work. This is how business cycles work. There's likely to be a crash. All of them have also failed very often in predicting actual economic collapses, crises, and crashes, right? In fact, if you remember, the World Bank also says uh, after about 10 years, 10 to 15 years of the structural adjustment programs, when the riots break out, IMF riots, and then the UNICEF is publishing its reforms, adjustments with a human face kind of reports, then the World Bank frankly admits that it did not foresee, did not anticipate, it did not factor in the potential likely impacts of its policy prescriptions, the SAPs, on the poor, on the most vulnerable sections. That when it put together the SAP's package, it was primarily obsessed with GDP recovery, etc. So, and then one can argue that, well, the World Bank had access to information. It had, if anything, it should have had a macro picture. It should have taken different sectors into account. Yet it did not happen. So, I'm saying that when this is a sort of a largely it's also not a planned state intervention. It's an NGO sector intervention, microfinance. It grows in size because of a certain conjuncture of circumstances. And like I said, it appeals to people across the spectrum. And then it takes time for this realization that these features are not working. And these are the reasons why these features are not working. So, this ability, I think, to forecast, to know in advance, to prevent in advance is not something I think that is even there. That any of us have access to like that. I don't think that that's a sort of a fair expectation or reasonable expectation to have had that in hindsight we look at the development of the sector. But then, of course, one thing that we can always do is to map the ways in which this whole discourse around neoliberalism, the way it prioritizes the viability of the lending institution, of the institutional actor, all that has shaped the microfinance sector, right? You can directly map that, and I think I've done that also in the lectures. But that was how it was intended to be, right? That was not unintentional. That was supposed to be the learning of the past, in which you could not have, like the Ohio school says, you can't have institutions that are not viable anymore. That's a particular kind of a discourse that puts cost recovery at the center. So yeah, that's what I would say to your question.
Any other questions? Shreya Ponne, still there?
Yeah, I'm here. But,
There's someone called Show. Is that Ishan?
actually, no, I wanted to introduce in the beginning, but then because we were setting up, we didn't. I'd like to introduce everyone. Show can, I think, speak on her own only, but Sorry, didn't get time. We were both in Assam also and just came down. But Sho is Shoini, and she works with JJSS in Bihar, and largely with the landless rural agricultural workers there in northern Bihar. So she has also joined us today. And
Very
Sho, you'd
happy.
like to say something? Then please go ahead.
Hi, Shohini, welcome.
Hi, hi. Thanks for having me, guys. I mean, Shreya told me about this initiative, and it just seemed like what one was looking for also, because especially when you're working with landless sathis, and at least in Bihar, this whole Jivika program, which is the state part of the state rural livelihood mission program,
Yeah, yeah.
yeah, so they're all getting trapped in all of that in a big way, and I can sense the anxieties. I mean, we're all sharing a lot of those anxieties because one is not sure where this is headed. In some vague way, you realize that it's actually not helping, but it's also in the early stages, so people are getting drawn to it, and you don't have enough arguments either for or against, and you definitely don't know what I mean enough. At least I don't know enough about the alternatives clearly that one can suggest. So this just seemed that it seemed like it was happening at a very opportune time, and so Shreya very kindly sort of roped me in also. But yeah, thanks. I've been doing some of the readings and listening to some of the previous lectures. So I've been doing my homework a little late in the day, but trying to. And yeah, this is immensely helpful. And once I mean, I managed to understand a lot more. Of course, today was my first day, so it is quite a bit to take in, but it all makes sense. And so maybe once one understands these things a little better, then I can also, I mean, it'll also help me communicate with our sathis in a language that's much more accessible to all of us. I mean, of course, you broke it, Kalpana, you've broken it down quite a bit. So it's easy to understand, but also, maybe in Hindi and, things that are more suited for our friends over here. So maybe we can all collectively work on that here at the local level once one has a better idea of all these related issues. So, so this is very helpful, and thank you, and thanks for having me. And yeah, we have to keep learning from the process.
Yeah, thanks for
Is it?
Thanks,
joining,
Sho.
Shohini. We
But
also
before we
share your email
sorry.
ID so that we can join, we can keep you on the loop on the email list that we are having. Shohini? Yeah,
Yeah,
okay.
sure. I'll message
Yeah,
it to you. Is
yeah,
that
yeah, sure.
okay?
Babu, can I just add one thing? Sorry, if there are other questions and things, then I'd add this at the end because it's little bit, matlab, unrelated. So first, if anyone
Are
wants
there
to
any
ask
other
or say
questions?
anything, then I'll say.
I don't think so, Shreya, so you can start.
Okay, sorry, it's a side note, but I think also relevant at some level. And since we've just come from there, just as of yesterday, just wanted to also say that one of the things we saw in Assam with regards to the NRC was that it's created huge amounts of indebtedness as well, and in in these very almost you'd say evil ways in a sense, because what happened was that one is that the worst type, of course, to get your documentation in order to travel to hearing centers again and again and again, 4 times, 5 times, 3 times, all of these things, all of that required a lot of indebtedness. But what happened was, and this was one of the worst things, that the last day of the NRC list, the cutoff, there were 2.5 lakh objections filed by anonymous, mostly people. Largely, one presumes and was is led to believe people like from groups belonging to groups like the ASU and things, with the Assamese Hindu chauvinistic groups. So, and also a lot of the RSS groups, because and these were blatant things. People at the hearing centers were told that ज़्यादा हल्ला मत करो, यहाँ पुलिस भी है और RSS वाले भी है. But 2.5 lakh objections in a matter of 12 hours. And so, what these objections meant were that the objections were not why am I not included? The objections were why is this person included? So, 2.5 lakh Muslim names essentially. Many of them belong to regions like the Chor Islands, which are these land masses in the middle of the Brahmaputra river that come and go seasonally, periodically, are eroded every year. So it's largely small landholding peasants. They do peanut farming for say like which takes a 4 month cycle, and one biga of land will give you about 4 to 5 quintals, and each quintal you sell for about 6,000 rupees. The same people every year for 2 months of the year have to migrate from these islands either onto the Chapuri villages, which are the embankments on the mainland, or in the not so bad nights they sleep on boats. That's the only time they know the state in any way, because only for 2 months do they get PDS. For 2 months, the 10 kilos of rice for 2 months and 2 kilos of dal. So what happened when communities like this, especially, and others were part of these 2.5 lakh objections, when you got the notice about like 12 hours to 24 hours before you had to be present at the hearing centers, most of which were in like the northeastern part of Assam, Jorhat and things. So last minute they are running to book buses and get like 40,000 rupees per bus and all that to reach there just on time. So they're saying that a huge like number of families have gotten into these new cycles of heavy debt because of this process. I just thought, I know that it's not exactly, I just wanted to share that as a part of a counting exercise of the state, how it can also, I mean, you were earlier saying, Kalpana, about how there is a strategic, I mean, it's a larger economic policy of the financialization of the economy and things like that. So I think like it happens in so many ways, no, not just in under the guise of having credit that is accessible to the rural poor, but even in the kind of counting exercises the state takes on. So just sharing that.
Yeah, of course. Of course. Thank you.
So Shreya, will there be a report of your exercise or?
Yeah, definitely, but it will take time, Babu.
Okay, no, I'm just asking so that the rest of
Yeah,
people
yeah.
know.
Of course, we'll share. Of course, definitely. Yeah.
There are any other questions? Shall we wind up for the day? And then Rahul will send out the recording hopefully by Wednesday so that people who are not here can access it before next Monday.
So, Babu, has Kamal then managed to get it recorded today because of whatever I downloaded? So that's Pakka
We
now,
will check
right?
with that after we close the session. Yeah.
Okay, okay.
Yeah.
But I also have to say, last week's recording was also super. I missed the lecture, so I saw that it was very clear and like.
Okay. Yeah, we got lucky last week. Hopefully this week also we'll get lucky.
Yeah, and just to say that next week, I'm definitely, I mean, usually I don't know in advance what I'm going to do the next week, but this time I know it's going to be the gender question. It's going to be the gender and microfinance question. That's what my 2 hour lecture next week is going to be on. That much I know.
Okay.
So, yeah.
Okay, I'll send out an email to people then.
Sure. Yeah.
Okay, everyone. So thank you. Thank you, Kels.
Yes. Thanks, Babs.
Thank you.
Thank you.
Thank you, Shohini, for joining. We'll be in touch. Yeah,
Thanks so much.
Thank you, Shohini.
This was great.
Thank you.
Thanks.
Yeah. I'll send everyone the papers, my 2 EPW papers, and yeah, along with the news whenever. Thank you, guys. Bye bye. Good night.
Yeah.
Good night.